Welcome to the Advisory Group's Economic and Market Update and Year-End Proactive Tax Planning for 2023 workshop. Let's first start with some introductions. My name is William Glenn, and I am a Client Services Associate as one of our TAG team members. Also joining me are Brent Beverly, the President of the Advisory Group, Chris Lee, the Vice President of the Advisory Group, as well as Manny Chinche, a Senior Advisor at the Advisory Group. All three of these advisors are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can help them make an informed decision. We believe that the more you know, the more you will like what we do and how we do it. Our agenda is very straightforward today. First, we will share with you a brief economic and market update. Then, we will discuss some proactive tax planning for 2023. As a reminder, it is always important to review that there are 5 key areas of financial planning. These are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we will always consider the impact of any recommendation we make on not just one, but all these areas for our clients. In this workshop, we will primarily be focusing on tax planning and investment planning. To get into the meat of our presentation, I would like to bring up Manny Chinche. Manny?
Thank you, Will. Looking back at last year, investors remember that 2022 was a very rough year for equities, and the Standard & Poor's, or S&P 500 as it's commonly called, and major market indexes finished the year with negative returns. There you see the S&P was down 20%. As we enter 2023, investors were hearing about some major concerns, which included the fear of a recession, inflation concerns, rising interest rates, global unrest, which included the war in Ukraine, and possible federal government shutdowns. Having said that, as you look at this chart of the S&P 500 from January of 2022 to September of 2023, you can see that in 2022 the markets ended down big for the year. But by late September of 2023, the recently concluded month, investors have experienced a positive return in those major indexes for 2023. So 2023 has been an interesting year, but as of now, year to date anyway, equity markets are up from January of 2023. This reinforces our thoughts that when it comes to equities, we believe that investing for the long term is a great strategy. So while there are many factors that can affect the movement of equity markets, here are some major equity market concerns that we still need to monitor. The direction of inflation rates, further interest rate changes as a result of inflation, recession concerns, and of course, geopolitical unrest. Now, these items could be major factors in determining the future direction of equity markets. As this graph on your screen shows, inflation numbers for August of 2023 were down from 2022 highs, but they still remain a concern. Since March of 2022, we have seen 11 interest rate increases. So over a short period of time, the federal fund rates has gone from near 0% to over 5%. Now, even though inflation is showing signs of slowing and interest rates are being increased at a slower velocity, policymakers are still predicting that they may need to raise rates again later this year. Fed officials did not raise rates at their last meeting, but they said in their policy statement that they were giving themselves time to assess how the economy was reacting to what has been a rapid campaign to slow demand and wrestle rising inflation under control. We believe the Fed is likely to further raise interest rates at least a quarter of a point before the end of the year. Now, Fed officials are watching key indicators to assess what they will need to do to continue reducing inflation, which includes labor statistics and the consumer price index. As you can see from this chart on your screen, we're still nowhere near those interest rate highs of the 1970s and 1980s. However, we're higher than the 2010s, when we experienced historically low interest rates at or near zero. Now, rising interest rates aren't all bad. They give investors the opportunity to earn higher interest on their cash, money market funds, and bonds. And this year we have seen some reasonable investment opportunities. So if you have cash or other accounts that you would like our help with, we would be happy to talk with you. Some analysts think we're out of the woods for a recession. Others think we still could see a recession, but it just may be delayed. Now, the economy and jobs are still remaining strong, but that does not mean the coast is clear. Regardless of if or when we could see a recession, the likelihood of it being severe is actually low. The global economy has been in a very vulnerable position. Issues including the ongoing war between Russia and Ukraine, the trouble in Gaza, and potential conflicts with China are contributing to geopolitical unrest. Equity markets do not like the uncertainty this brings. Now, we will continue to keep an eye on how geopolitical issues may affect the markets here in the U.S. Now, to take a look at the equity markets, allow me to bring up Mr. Beverly. Brent?
Thank you, Manny. Now, I love this. On the same day in September, Business Insider magazine had two headline articles that each painted a very different picture for investors. So one was titled, Stock Market Crash, Recession Will Sink the S&P 500 by 40%. And the other one, same day, was titled, Why the Stock Market Could Rally 25% in 12 months, according to Bank of America. Now, bottom line, they don't know. Well, we don't know either. We do not try to predict the highs and lows of the market. As financial professionals, we try to provide proactive, long-term planning for clients. While no one has a crystal ball that works, historically, the fourth quarter of the year is a good one for investors. Now, this chart shows 70 years and includes several very difficult fourth quarters, including, for example, the October of 1987, when the market collapsed and had its worst single day in history. So when studying 70 years of returns, though, 78.6% of the time, fourth quarter ended the respective year on a high note. So as we head into the end of the year, we'll keep an optimistic eye on equity markets. As you can see from another view, once again, those investors who focus on a long-term strategy were historically rewarded with significant returns. While ups and downs are a part of the investment experience, the 20, 40, and even 10-year investment timeframes have shown a healthy upward path. Now, we're of the belief that with volatility comes opportunity. So, for example, where it fits your strategy, we like to use dollar cost averaging to help take advantage of volatile markets. Now, let me share a secret on this graph with you. Do you see it? Note the heading where it says, as of September 27th, 2022. Do you see that up there? Now, why would we pick that particular date? Remember our chart early in this presentation. We showed the market dropping in 2022. September 27th of 2022 was the low point of the market in 2022. What has the market done since then? Well, remember that same chart. It's gone up, wouldn't you say? If the long-term growth lines look good running to the low point in the market, wouldn't they look even better going to where the market is currently? Well, of course. And that's the point here. Let me say it again. Those investors who focus on a long-term strategy were historically rewarded with significant returns. Now, that said, past performance is not an indicator of future performance. 2023 has already been an interesting year, and it's not over yet. We stand by our mantra of proceed with caution. Please remember, we'll be watching all areas of the economy we feel may affect our clients, and we're here for you and any concerns you may have. We would like to remind you of the 4 things that can help us approach your investments with discipline and focused direction. Your risk tolerance or appetite, and by this we mean how much risk can you take, or better yet, how much can you afford to take. We watch your time horizon and the amount of time you have to be invested in any situation, which can help you determine your entry and exit points. Your behavior. Market volatility is a part of the investing experience. Now, this can create anxiety and stress when volatility occurs. Do you know how well you can emotionally endure the potential ups and downs of your investments? And finally, stay focused on your overall strategy. Don't get caught up in the emotional investing. Are you looking at something that doesn't quite fit with your overall strategy? Perhaps the media is influencing you to make rash or impulsive decisions on your investments. We will help you overcome the short-term fear and greed on your investments, those emotions that might distract you from your long-term approach to investing. We want your holdings to be consistent with your overall strategy. Short-term panic can create more risk and potentially cause setbacks in your goals. We believe that the long-term success comes from maintaining your overall strategy. This is key. This might be an ideal time to remember the words of wisdom from that legendary Warren Buffett. And I like to quote here, "The most important quality for an investor is temperament, not intellect." Here are some of the key items we will hope you take away from our equity market review today. Caution is still the principal notion for investors. Inflation, while slowing down, continues to be a concern. Interest rates should continue to rise for a while. A recession is still a possibility, but as a reminder, long-term investing is a key strategy with equity markets. And as always, we're here to help you. Now let's shift to proactive tax planning for 2023. Now, we believe that taking a proactive approach to your tax planning instead of a reactive approach can produce better results. Let's start by quickly distinguishing the difference between tax planning and tax preparation. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after year end. What we do is tax planning. Your tax advisor is the one who's going to help you with the tax preparation. For 2023, there are still 7 individual tax brackets: 10%, 12%, 22, 24, 32, 35, and 37%. Now, in addition to the chart in your handout for this workshop, you can find these rates and more on our tagfinancial.com website. Under current law, this 7-rate structure was created by the Tax Cut and Jobs Act, but it's scheduled to automatically phase out on January 1st of 2026. Now, we're going to have further education on that as that date gets closer, so be sure to stay tuned. For 2023, though, the standard deduction amounts for those who do not itemize has slightly increased. The amounts are $13,850 for individuals and couples filing separately, $27,700 for married couples filing jointly, and then a whopping $20,800 for heads of household. So with that, how should you view itemized deductions if you do not take the standard deduction? Now, the old rule was primarily to try to accelerate or realize deductions and take them as soon as possible. The current higher standard deductions, though, the new rule is to carefully plan or time those deductions to maximize them in a given year. Another thing to be watching in 2023 are the long-term capital gains, which still receive a substantial federal income tax break. Now, there's still 3 rates for long-term capital gains: 0% up to $44,000 for single, or $89,250 for married filing jointly. Then it goes to 15% for a big area there, and then 20% for long-term capital gains over the higher limits there. So remember, these are rates for assets and investments that have been held for at least a year or more. Now, to discuss some strategies you may want to use, let me bring up my business partner for almost 40 years, Chris Lee. Chris?
Thank you, Brent. Brent just discussed the rates for long-term capital gains. As part of a year-end tax planning strategy, it can be helpful for taxpayers to review their opportunities for tax gain and loss harvesting. Harvesting capital losses is a strategy that has a taxpayer selling assets that are a loss to offset capital gains. This is a tax deferral strategy that could be valuable. A key fact to remember is that you can use up to $3,000 in capital loss above capital gains to offset ordinary income. Note that this reduces to $1,500 if you are married filing separately. Capital gains harvesting means taking capital gains and paying taxes in the current year. Remember, when taking a long-term capital gain for tax purposes, while the tax is paid at a lower rate, it is paid sooner. For those who are not fully retired yet, remember to review your retirement contributions to make sure that you are maximizing your retirement and tax planning before the year end. If you are short of your maximum contribution for the year, you will likely need time to get contributions increased before the end of the tax year. Here are some 2023 contribution plan maximums that could be applicable if you're participating in one of these different plans. If you're age 50 or older, you can take advantage of the catch-up figures to increase your contributions for the year. If you have questions about retirement plans, please call us. For some people with IRAs that have not been taxed, a partial or full Roth IRA conversion could be something to consider. Some benefits from Roth IRA conversions include they could lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no required minimum distribution, which currently starts at age 73 for traditional IRAs. Roth IRAs allow tax-free withdrawals for beneficiaries. Roth IRA conversions are not for everyone, but if you would like to explore this concept, then please see us or your tax professional. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. Keep in mind that a Roth conversion does not satisfy your required minimum distribution. You must take your RMD as income, and then you may execute a Roth conversion, drawing income yet again. As a result of the Secure Act, overall family tax bracket management is a critical area for those with untaxed retirement assets to explore each year. One of your choices is always to leave everything the way it currently is. If you're in a higher marginal tax bracket than your beneficiaries, then it might make sense to let them take the distributions after your death in their tax brackets rather than in yours. In this case, doing Roth conversion does not make sense. However, if your beneficiaries are in a higher marginal tax bracket than you are, then it might make sense to take distributions in your tax bracket while you can, and then convert these to Roth IRAs and leave your beneficiaries an account that, while it still must be taken within 10 years after your death, can grow tax-free all that time. An annual consideration is to review your marginal tax rate and that of your beneficiaries.
Since we're talking about tax savings, college savings plans can also bring tax efficiencies. If you want to explore tax-efficient ways to save for college, such as the 529 College Savings Plan, please give us a call. To bring us some ideas on gifting, please allow me to bring back up Mr. Chinche. Manny?
Thank you, Chris. Now, let's spend a few minutes on annual gifting now. Now, you may gift up to $17,000 tax-free to each donee in 2023. This is a $1,000 increase from the $16,000 number we had in 2022. These annual exclusion gifts do not reduce your lifetime gift tax exemption and don't require the filing of a gift tax return. This annual exclusion gift has doubled to $34,000 for gifts made by married couples. We like to say this as the annual exclusion gift is $17,000 per person per person. Now, you can also help someone with medical or education expenses without incurring gift taxes. There are also opportunities to give unlimited tax-free gifts. The magic of this is that you need to pay the provider of the services directly. The key word here being directly. Do not pay the person, write them a check so that they can pay the institution. Pay the institution yourself directly. Medical expenses must meet the definition of deductible medical expenses. Qualified education expenses are tuition, books, fees, and related expenses, but not room and board. Now, you can find the detailed qualifications in IRS Publication 950 and the instructions for IRS Form 709 at www.irs.gov. You can easily find that link to the IRS website on our tagfinancial.com site. Now, for those of you with larger estates, a wealth transfer planning item to think about is the exemption amount for gift, estate, and generation skipping taxes for 2023 being $12.92 million. Now, this doubles to $25.84 million for married couples. Any amount over that is subject to 40% in federal taxation. This high amount provides high net worth individuals a significant planning window to make gifts and set up irrevocable trusts. As a reminder, as of now, in 2026, the state tax exclusion will return to approximately $6 million, which comes out to $5.6 million adjusted for inflation since 2018. On November 26th, 2019, the Treasury Department and the Internal Revenue Service issued final regulations under IR 2019-189, confirming that individuals who take advantage of the increased gift tax exclusion or portability amounts in effect from 2018 to 2025 will not be adversely impacted when this tax law change sunsets on January 1st, 2026. So if you have a large estate, this is definitely something to discuss, so please call us. Qualified charitable deductions, otherwise known as QCD, are still a strategy for retirement savers. As part of the Secure 2.0 Act, required minimum distributions, or RMDs, were changed to start at age 73 instead of age 72. Qualified charitable distributions, or QCDs, are a tax law provision that allows retirement savers to directly distribute up to $100,000 per year to eligible charities straight from their retirement accounts and not pay tax on this distribution. Now, QCDs use the original RMD age, so you only need to be over age 70 and a half to use that QCD strategy. Now, one idea that experts suggest, if you are charitably inclined, consider using part or all of your required minimum distribution for a qualified charitable distribution. If you meet the qualifications to utilize this strategy, the funds must come out of your IRA by December 31st, 2023. They must also go directly to an approved charity. Now, like many of the other strategies we're discussing today, this is one that needs to be done properly. So please see us or your tax professional regarding this strategy. Now, the Tax Cuts and Jobs Act, or TCJA, passed in 2017, brought many changes to the tax code. Unless any changes are signed into law, here are a few key tax rules that are set to expire on December 31st, 2025. Now, some changes that are already scheduled include individual income tax rates. If no action is taken before 2026, these tax rates will expire at the end of 2025. In 2026, we will go back to the 2017 tax rates based on incomes adjusted for inflation. The tax rates we have today are much lower and much wider, meaning that in many cases, more income is taxed at lower rates when compared to 2017. For planning purposes, given the same level of income, most people could find themselves paying more in taxes in 2026 than in 2023. Elevated estate tax exclusions. As of now, again, barring any changes in 2026, the estate tax exclusion is due to revert to pre-2018 levels, adjusted for inflation, which we expect will be approximately $6 to $7 million for individuals. This is almost half of the current limit of $12.92 million for individuals and $25.84 million for couples. Currently, there is a 40% maximum gift and estate tax rate. This rate is set to increase in 2026 to 45%. State and local taxes. The SALT cap will disappear. The TCJA eliminated or limited many of the previous laws concerning itemized deductions. An example is the state and local tax deduction, which is currently capped at $10,000 per year or $5,000 for a taxpayer filing separately. This cap is set to dissolve after 2025. The child care tax credit is set to revert to $1,000 from its current level of $2,000 for children under age 17. And finally, the AMT is back. The alternative minimum tax will likely hit taxpayers much harder as it did before 2017. Now, we enjoy keeping clients aware of tax law changes. We invest hours each year reviewing how these changes might affect you. So you can be sure you will be hearing more about the sunset provision as we get closer to 2026. Now, one of our goals is to keep clients updated when tax law changes so that they can proactively plan. If you'd like to discuss how these sunsetting rules or any tax law changes may affect your situation, please feel free to contact us and we'll be happy to assess your unique financial situation. Now, to take us to the end of our presentation today, please allow me to bring back up Mr. Beverly. Brent?
Well, thank you, Manny. We've covered a lot today. So what can you expect from us? One of our main focuses is to review changes for our clients on an ongoing basis. You can expect us to provide regular communications, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. And in fact, we will be offering other workshops that highlight these upcoming tax changes and planning ideas. We're thankful for the opportunity to assist you with your financial needs. Remember, at our firm, clients come first, and your health and well-being is our highest priority. Of course, there are some important disclosures that need to be made. I recommend that you pause this page and take a careful read through on this. At the bottom is our contact information. So if you want to reach out to us, here's a bigger view of our contact information. That concludes our presentation today. Thank you for watching and have a wonderful holiday season. Best wishes.